Hello everyone and welcome to This Week in the Markets. This week, US passed a temporary bill to allow it to disregard the debt ceiling until May, and economic data were mixed, although the housing market is showing signs of growth. The Bank of Japan adopted a 2% inflation target but delayed its open-ended purchases until 2014. And earnings seasons in US so far has been demonstrating modest performance. We'll go through this news in more details after our disclaimer. So information contained in this video is intended to be general advice only and should not be regarded as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situations, or particular needs. So you should, before acting on the advice if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. So the House of Representatives passed a temporary bill on Wednesday to avoid the debt ceiling for another 4 months until May 18th. This allowed the federal government to continue borrowing money to meet its debt obligation and to avoid a repeat of 2011 situation where the standoff between Congress in negotiation caused a downgrade to the country's credit rating. However, this is obviously just postponing the problem rather than solving it. So all it means is that rather than worrying about a near-term defaults and credit rating downgrades during the next month, investors can delay their votes for another 4 months and enjoy the bullish ride right now. Nonetheless, the upside will probably still be kept as the market doesn't like uncertainties, and delaying uncertainties doesn't help to alleviate it. Now, economic data from US over the last week were mixed to slightly bearish. There is the housing starts for December, which came in considerably better than expected at over 950 million. As we can see from the chart, the rate at which new homes are being constructed in US is growing rapidly over the past few months, so there's been a quick surge in demand. And this speaks a lot for the housing market recovery in US. On the other hand, the existing home sales is still growing but not as quickly and actually fell slightly last month. If we want to give this conflicting data a bullish twist, we could say that those who can afford buying their own house in US are actually purchasing new ones rather than existing homes due to how cheap the prices are. This of course might be just wishful thinking, but one way to check is to wait for the new home sales data, which will be released on the coming Friday. The Reuters and Michigan survey of consumer confidence fell again at the beginning of January after a sharp decline in December. We can understand the decline in December due to the fiscal cliff falls, but we expected January confidence to improve. Nonetheless, this is only the preliminary reading of the January survey, and it might be too early days to tell. And maybe there might be concerns of the debt ceiling as well. Consumer confidence tends to affect willingness to spend on cyclical goods, so we'll need to check back on the final measure, which is in February, to see whether consumer confidence actually fell or not. In Japan, the Bank of Japan adopted a 2% inflation target, which doubles its initial target of 1%, after being pressured by the new government to step up measures to fight a strong yen and weakening economy. However, the central bank failed to deliver on the open-ended purchases, which Shinzo Abe also tried to push for. And instead, Bank of Japan Governor Shirakawa said that the program will begin next year, which pushes the schedule back a year and likely past term as the governor. This is the biggest letdown for the regime since the new government was elected and sent a signal to traders to begin taking profit on their positions. Consequently, the dollar-yen had one of its sharpest declines after the BOJ statement. The 90 level has become a stiff resistance after failing to break through there in the last few days. And it is no surprise to anyone that the dollar-yen is at least slightly overbought in the short term. And we think that if Shinzo Abe and his party does not come up with new ways to stimulate the economy and pushes through new policies, the dollar-yen could quickly fall to test the 87 level and potentially to the 84-85 level as well, if traders lose confidence in the new government. And the fourth quarter earnings seasons in US so far has been quite alright, with around 76% of the companies in the S&P 500 beating expectations on earnings. And on average, the earnings per share is 5.94% more than expected. Now, this is not stunning growth by any measures, but still portrays an economy that is improving modestly more than analysts' expectations. The chart that intrigued us most this week is the chart of the VIX, which is an index of the volatility premium as on a range of S&P 500 futures. This chart tells us in a broad sense how cheap or expensive options are in the US. And as we can see currently, the options premium are now the cheapest it has been since 2007. So as traders, it makes buying options an attractive way to express our views on equity markets, regardless of whether we're bullish, which in case we'll buy a call, or bearish, in which case we'll buy a put. And that's all for this week in the markets. We'll have another update for you next week. Until then, on behalf of the trading business team, we wish you all profitable trading.